Okay, I think we'll get started here today. Thanks everyone for being here today. Lyle's going to be on here with me as well, but I'm not sure if he made it in here yet today. So we're going to go ahead and get started. Our topic for today is a couple of things. We've got three distinct topics for you today to discuss about this year ahead in 2023. Obviously, we've had an eventful year in 2022, lots to talk about, lots of economic things to talk about, lots of market things. So we're certainly going to touch on the broader market here today. We're also going to touch on inflation, which maybe we're not hearing quite as much about, but it's still very much a big driver of what's going on today in the market and the economy as a whole. And of course, has a lot of effects, both broadly speaking and to all of us, just as individuals in our day-to-day lives. And then we're going to wrap up talking about a recent congressional bill that was passed at the very end of 2022, what they're calling the Secure Act 2.0. And there are some implications in there for probably just about all of you, most of which we think are positive. So we'll review some of those today as well. As we get started here, as always, we have the Q&A available to you as a participant. So any questions that you have, please send them in. We'll either reply to those in the chat or we'll reply to those live on the webinar. And again, thanks for being here and listening today. So we're going to get started with our first topic, which is where we stand. Where are we today after this crazy investing year of 2022? And this is a broad look at the overall market and what happened last year, but also, and in our opinion, of course, more importantly, what has happened over the past 5 and 10 years in the market. What you see for last year is a lot of red. That's probably not a surprise to most of you if you've been watching your investment accounts. U.S. stock market as a whole down about 19% last year. International developed markets actually outperformed the U.S. Emerging markets did about the same as the U.S. Real estate was surprisingly a big loser last year. But something out of the ordinary from 2022 is that U.S. bond market number, down 13%. That's the worst year for bonds since we can find, since we have data for, all the way back to the 1920s. And the global bond market was the same. And as we've been talking about in a lot of our publications and webinars, is when interest rates go up, bond prices go down. And so we saw that significantly last year, and we'll see what's ahead here for 2023. We are going to touch a little bit on that when we talk about inflation. But of course, we're long-term investors, so we need to zoom out. When we look at those 5 and 10-year numbers, we still see green arrows almost across the board, definitely at the 10-year mark. But one of the most interesting things that has happened over this last decade is the strong outperformance of the U.S. stock market relative to international stocks. You can see here on 10 years, the U.S. stock market up just over 12% per year on average, even with last year included. And international developed stocks, 4.5%, emerging market stocks, only about 1.5%. So overall, the U.S. market has been on a fantastic run over the last 10 years. And interestingly, that is not new. The U.S. market and international markets tend to go in cycles of outperformance. The United States will outperform for a long period of time, and then emerging markets or developed markets will outperform for a period of time. But one interesting note is we are in the longest time of U.S. outperformance, again, back since we can measure it. Over 13 years, the U.S. has outperformed as a whole international markets. And so that leads to some interesting dynamics. It does make it hard to continue to be comfortable holding your international positions, but we still believe there's value in diversification. And certainly when we look at market fundamentals, there are some very attractive opportunities abroad. Let's zoom in a little bit on the U.S. market. This is specifically looking at the S&P 500, which is a decent bellwether for the U.S. market, although it only includes the largest 500 stocks in the United States. And I show this chart just to show you, like you probably already know, that the market goes through cycles of positive return and cycles of negative return. And generally speaking, we see that happen throughout market history, where we have these solid periods of positive returns, then we have a pullback, then we have another solid period of positive returns, and so on and so forth. What you see in this chart is starting down in March of 2009, when the market bottomed after the crash in 07 and 08. We went on an unbelievable bull market run to February of 2020. 401% return on the S&P 500. So I guess you could say, if we're looking at patterns, that we were due for a pullback. We, of course, had the March of 2020 down 34%. That happened in just over a month. We lost 34% just like that. We've recovered from there, and now we're at about 17% down off the peak that we hit on the first trading day, actually, of 2022. So you look at these cycles of growth and retraction and growth and retraction, and what it all leads to is the S&P 500, while it rides this roller coaster, tends to give us somewhere between 9 and 10% a year over a long period of time or over a full cycle. So even though we see these ups and these downs, positive returns still remain for long-term investors. So what should we focus in on when we're thinking about expectations for future market returns? Of course, it's a question we get a lot. They say, Gary or Lyle or John or Charlie, we know you don't know the future, but what do you think's ahead for the market? And as we say, we don't have a crystal ball. Nobody does. But we can look at some data that could at least suggest to us what we may be able to expect in the future. And one of those very important data points is price earnings ratio. And this ratio is essentially how much are you paying for $1 of earnings for a stock? And that can have a strong correlation to future returns. That's what you're seeing in these two charts. The chart on the left is the current price earnings ratio of the market. And then all the gray dots is the next 1 year of returns. And what you see is you have a pretty broad smattering of returns. But when we go out to 5 years, what we see is this orange line, which is all the different price earnings ratios measures, whether it's higher or lower, and the subsequent returns of the market. The further left or further right we are on the chart, the higher the price earnings ratio. Over on the left side, the lower the price earnings ratio. And what you see is a pretty much linear equation and a tight dispersion that the less we're paying per dollar of earnings, the higher our forward-looking returns are. And so where we're at today is we're pretty much right in the middle. Price earnings ratio is right about on the average, trading a little over 17 times earnings. And so what that means is it's not unreasonable to expect that the next 5 years could give us somewhere around that average stock market return of plus or minus 10%. Don't take that as a prediction because we don't make predictions, but it does give us an indicator of where we sit today. And we're certainly not on either extreme end of this chart today in the market. Another way to look at price earnings ratios is to divide up the stock market into some different categories. One really easy divider that you've heard us talk about before are value stocks and growth stocks. And how do we characterize those? A growth stock would be a stock that's measured more by its revenue growth. So the total amount of revenue a company brings in. That's the main measurement for a growth stock. A value stock is more measured by its earnings, the net income or net profit generated by the company. And so when we think about that, we say, okay, in one category, we're measuring revenue growth. In another category, we're measuring profit. And that, generally speaking, gives us an idea of what's a growth stock versus what's a value stock. Here at Masters, we like the profitability measure a little bit better than the revenue growth measure because that's real dollars. That's real dollars that are going to get returned to the investor in the form of investment returns. And so what we're looking at in this on the left-hand side of this chart is which is more expensive and which is cheaper when it comes to what I'm paying for a growth stock, what I'm paying for a value stock. If we're above this green line, it means that growth stocks are cheaper than value stocks. If it's below the green line, it means value stocks are cheaper than growth stocks. And you can see we hit a low point back in 2020 and 2021 where value stocks were very, very inexpensive relative to growth stocks. And what we saw play out in 2022 is that growth stocks got hit much, much harder last year than value stocks. To make that a little more real for you, the NASDAQ index, which generally measures more growth-oriented stocks, more technology type of stocks, was down about 30% in 2022. While the Dow Jones index, which is more of your industrial stocks that tend to be more to the value side, was only down about 3-4% last year. So you saw that total stock market index down 19% on the first slide we saw. There's significant dispersion between what parts of the market did well and didn't. And so this can be another indicator to say, okay, value stocks are still cheaper than growth stocks. And that means I may want to consider weighting to value so I'm paying a little less money to get access to those future earnings of the stocks that I'm buying. Another focus that we have in our portfolios as we're thinking about the market are smaller cap stocks. So the chart we looked at that showed us the ups and the downs, that only measured the 500 largest companies in the United States. But there's a whole nother investing universe of a couple thousand more stocks that we invest in our portfolios, or at least the universe we pick from to choose our investments. And one of those sectors of the market are small cap stocks. And they're, as they sound, they're smaller companies than those companies in the S&P 500. And generally speaking, what we've seen is there's a little more risk in investing in small company stocks, but at least historically, there's been a higher degree of return associated with smaller company stocks. But one of the things that we've really been focused on here in our asset allocation over the last couple of years is which small cap stocks are we buying in our portfolios. We don't want to just close our eyes and throw a dart. And we also don't just want to buy everything indiscriminately. We want to apply some sort of filter to the types of positions we're placing into client portfolios. And what you'll see here is that it's gotten a little more difficult, as I point out in this chart in the top right of the screen. What this shows is the percentage of small cap stocks that are profitable versus ones that are not profitable. So it sounds a little funny, but yes, there's a lot of stocks who trade on the stock market, have significant market value that do not earn a profit, at least today. They have value because investors think that at some point in the future, they will start to earn a profit. And what we've seen is a pretty steady uptick, especially over this last decade, of more and more unprofitable stocks in this particular index, which looks at small cap stocks. And so we're now to a point where about 40% of small cap stocks are unprofitable. And we tend to wait away from the stocks that are unprofitable and tilt our portfolios more toward the ones that are. So this goes to the importance of knowing what's in your portfolio and having some sort of thesis around why do I own this particular stock or this particular part of the market. The last question, the big picture that you've probably asked yourself, maybe you've asked others, maybe you've seen in the news is, are we in a recession? We thought we were in recession last year because we had 2 negative quarters of GDP growth, and that historically has been the measurement for saying we're in a recession. But then we had some people saying, nope, even though that's been the definition forever, it's not the definition anymore. And so we're not actually in a recession. And of course, we don't know how much of that is posturing and how much of that is true. But what I can tell you is in the stock market, not necessarily the economy as a whole, but in the stock market, we typically measure a recession or a bear market as a time when the market has gone down more than 20%. That's the typical measurement for a bear market. And so if we use that just for the stock market, the answer to this question would be yes. The stock market experienced a recession back starting in January of 2022 as the high point. The stock market contracted by 25%. It bottomed out in early October of 2022, and we've been up since that point. So we may have already seen the end of this recession. As you can see, historically, the average recession has lasted about 20 months. This one, top to bottom, last year in 2002, only lasted 9. So there could be an argument to say, well, there might be another shoe to drop because this is a shorter than normal recession. But we get to that 20-month average with a bumpy ride of different durations, as you can see here, of bear markets. And guess what? You got to live through the shortest bear market in history back in February of 2020 of 1 month. We were down 34% in 1 month. That was the bottom, and it was up from there. So we're somewhere in between that time, but we would say if we're looking purely at the stock market, again, not necessarily the economy, we would say that yes, the stock market did experience a recession last year. And we're not quite sure yet if it's over or not, but we certainly have climbed pretty far out of it based on where we bottomed out last October. I'm going to pause there. That's my last slide on where we stand. And Lyle, see what questions we have.
Yeah, one question here was back on the slide where there was the dispersion of price to earning ratios, and as you went to the, one more back. Yeah, and I was just curious here, especially on the 5-year chart, when masters plan, when we do planning, do we factor in maybe what we think, based on where price and earnings ratios are falling currently? Do we, does that help with planning in any way?
Yeah, that's a fantastic question. So what I'm hearing there is, do we factor in what we think might happen in the future into our planning assumptions? So if we're on the left side of this chart, are we saying, oh, we can expect higher returns? And if we're on the right side of the chart, do we say, oh, maybe we want to expect lower returns? What we don't do is make future market projections. So the short answer to that is no. But what we do to control for this dispersion is we assume an average rate of return, but then we stress test our plans based on the possible dispersion of those returns into the future. So instead of picking one spot on the line, we're going to pick what we think is a reasonable and slightly conservative future rate of return. We're going to apply a possible range of outcomes on that return. We think we're going to get 5%, but we could get 8% a year. We could get 2% a year. And we're going to stress test and see, does this plan hold up, whatever the future market environment is? So it's less about picking a spot on the market and projecting forward, and more about applying the proper range of possible outcomes to see how a client's plan is going to behave, if they have average returns, if they have really positive returns, or if they experience more negative returns. The only other thing I'd add there is if we are at a point where we're on one of the extreme ends of this chart, it may influence some of our planning decisions. So for instance, if we're on the extreme left side of this chart, we're trading at really, really low multiples, we may be in a client meeting and say, hey, if you want to get more aggressive in your portfolio, this could be a good time to do it. or if you have cash sitting on the sidelines that you want to invest, this could be a good time to do it because price earnings are low, which would have been the case in the back half of last year, and even is the case to some degree still today, although not as strong. And then if we're on the other side of the chart and things are trading at really high multiples, that's probably meant that we've had really good returns over the past couple of years. We would be more cautious with those things. And we might say, if you want to pull back your risk a step or two, this may be a wise time to do it because these multiples are really high. Or if you have cash sitting on the sidelines, maybe we just give it some time until we decide how to work that back into your portfolio.
Yeah, it's helpful, Gary. Also, a question around the recession conversation. Can you explain a little bit of the relationship between what, our government, with GDP and those measurements, how a recession defined like that relates to how does the stock market correlate generally with a typical recession defined by GDP?
Yes, good question. So GDP growth is a backward-looking indicator. The stock market is a forward-looking indicator. So whenever you're looking at the stock market in a given day, what you're seeing is the collective assumption of all market participants and what they expect to happen in the preceding or in the next 6 months. That's about the measure. So the stock market is saying, okay, we're pricing today based on what we think is going to happen over the next 6 months or so. So the stock market's a leading indicator because it's based on future assumptions. Something like the fourth quarter GDP number, which just came out a few days ago, well, we're not in the fourth quarter anymore, we're in the first quarter. So we're looking back at what happened a few months ago. So what tends to happen is the economic data comes in after the stock market has made assumptions about what should have happened. So that's why when you see a surprise in the economic data, you'll see the market a lot of times pull back because it didn't meet their expectations back when they were buying and selling different vehicles and thinking about what they thought for the future. And I think a good example of this is just what we saw with the Fed and inflation. I mean, we all knew inflation was here. We saw it when we were going to the gas pump, we were getting our groceries. In our businesses, we saw the cost of raw goods go up exponentially. We saw used cars go up exponentially. We were seeing all these things, yet the Fed's still telling us, well, we're not sure if this inflation's here to stay. That's because they were looking at a 12-month backwards inflation number. So even though we're sitting here saying there's inflation, they're sitting here saying, well, we're not sure yet because we're looking at a 12-month number in the past. And so the market tends to be ahead of those things. And that's why those surprises of expectations being missed can sometimes shock the market short term.
Sounds great. Thanks, Gary. That's all the questions for now. Just a reminder, if you have a question, feel free to put them in the question and answer bucket there, and we'll grab them either live or we'll chat back to you. Thanks.
Great. So on to inflation. Again, we've heard a little less about inflation here the last few months, but it's still a hot topic in the markets and a big driver of what's going on in the economy. And there's a few things linked to it that I wanted to touch on here today. So here's where we stand on inflation. You can see we are down from the peak that we experienced back in the middle of last year, but still well above the long-term average. So the long-term average going all the way back 50 years, about 4% per year of inflation. And right now, at least December of 2022, we were still at 6.4%. So we're still well above, we did touch 9.1%. That was the peak. We're coming down from that, but we're still seeing heightened levels of inflation. I'm going to show you this on the next chart, but what I want you to understand about inflation is it is one of the most persistent economic factors that we have. That means when inflation is low, it typically stays low for quite some time. And when inflation is high, it typically stays high for some period of time. And so it doesn't waffle and wave back and forth quickly. It's a slow burning economic indicator. And so the idea that inflation is going to plummet is not well reasoned when we look historically. But of course, the one factor we do have here that's a little unique is all the money that was pumped into the economy over the last few years that probably did accelerate the rate of inflation going up, and could mean that the rate of inflation going down happens a little faster than it has in the past. But think about that with inflation. It's a persistent indicator, and certainly we've experienced that this last decade. We've had very low inflation. We were under 3% inflation from 2011 all the way to 2021. So a 10-year period of time, less than 3% inflation. And now that we're above that number, it would be reasonable based on what we see in history to say, we might stay there for a while. Now, this next chart has a lot going on. You don't need to look at all the individual boxes, but what I wanted to show you here is this is an inflation heat map. So this is showing us if we have a dark green, we have low inflation. If we have a yellow or green yellow, we've got medium inflation. If we've got yellow to light red, we've got high inflation. If we got dark red, we have really high inflation. And so I just want you to observe these patterns. When we go back to January of 2020, which is the furthest side of this chart, we see a lot of green. So a lot of green, inflation was low. Headline inflation year over year in January of 2021 was 1.4%. And then, of course, we can see how this line gets hotter and hotter and hotter. It's like playing hide and seek with my kids. You're hotter, you're hotter, you're hot. You found me. And we found the peak here in June of 2022 at 9% inflation. And so just look at how long it took to eventually get to 9%. There's one main reason why it takes a while to get there and why it might take us a while to get back down. That's because inflation looks back 12 months. That's how we get the year over year number. So even though in a given month, we might have had 9% inflation as we were climbing up to the peak, when we look back and we factored in all these lower inflation months, the headline inflation number might have only been, say, 4%. And so we're going to see that on the way back down. This June number of 9% is still going to be factored into the headline inflation number for the next 5 months. So it will be a slower burn down. Where you have some good news, as you can see here where we stand today in this column of the chart, December 2022, and we are seeing some green. Now, some of that's in energy, which tends to be more volatile as far as inflation goes, but some of that's in food. So in December, food prices only raised 0.3%. That's down from a high point of 1.2%. So that's come back down to a reasonable number. This next section of core goods, it's apparel, vehicles, used and new. We see that coming down, even see used cars with a negative number. So those prices are starting to come off. But one of the concerns that may keep us elevated for a little bit longer than we think are core services. So shelter, medical care, and transportation. We still got some significant red here. And you can see it took them a little bit longer to get into that red zone than some of the other factors here. And so it might take them a little bit longer to work themselves out. So remember, inflation, persistent factor, it might take us a while yet to get back down long-term to where we want to be. Now, there's some other things that are affected by inflation or have an effect on inflation. One of them is wage growth and unemployment. Unemployment continues to be at a pretty low point. Of course, we had that crazy spike in 2020 of 14.7% unemployment. The 50-year average is 6.2%. But today we're still sitting at about 3.5% inflation, which historically is about as low as we can get. That's pretty much full employment here in the United States. And so again, if that employment rate stays low, it will keep inflation high. People have jobs, people have income, consumer spending drives about 70% of the economy in the United States. So as long as people have jobs, people have money, they're out doing things, buying goods. Again, it's another reason why inflation may not come all the way down to where some think it might, or where the Federal Reserve really wants to see it. Another way to look at the labor market, a few different charts here. The bigger one is how many jobs are there available for every unemployed person. And right now we're still at a crazy number where there's 1.8 job openings for every one unemployed person. Excuse me. So we still need to see that come down pretty significantly until we get much movement in the unemployment rate. You start to hear more about some of these bigger companies, Microsoft, Alphabet, and some other large companies doing mass layoffs, but we're going to need to see a lot more of that for this number to come down meaningfully. And you can see that these numbers where there's not many job openings per unemployed person tend to correlate with economic recessions. So this would indicate that we're still pretty far away from a recession. We're probably also far away from, again, inflation really coming down meaningfully. And then these other two charts are a similar thing in a different way. This chart is how many people are quitting their jobs. And the higher that is, the more that means that the labor market's still hot. I'm only going to quit my job if either I have to for some reason, like retirement, which we have seen an increased amount of retirements the last couple of years, or if I can go get a better job or what I perceive as a better job. And so there's still a lot of that going on, which indicates a stronger labor market. You can see back at the last recession, not many people quitting their jobs when we're in the back half of 2008. And then the last piece is the layoff piece. Again, even with some of these big announcements, so this will go up a little because this is a November number, but even with some of these recent announcements, we're still historically low for layoffs. So the demand for labor is still very, very strong. As long as that stays strong, that should keep the economy strong. But again, it might also keep inflation a little bit higher for longer. How is the consumer doing? How are we doing as consumers? Well, our conclusion to this is we're almost back to where we were before 2020. And there's a few pieces of information on here to point out on that. The first one is the current household debt service ratio. So that's how much of my disposable personal income is going to pay my debt. What you can see is we hit a peak there in the fourth quarter of 2007. Not good timing to have a lot of debt. Of course, that plummeted due to some defaults and people defaulting on debt. And we've done a pretty good job managing our debt since then. We're still lower on the debt service ratio than we were back to when this chart begins, which is 1980. But what you can see is we went right back just in about a year and a half to where we were there at the beginning of 2020. And so, of course, all this money was pumped into the government. A lot of consumers made good choice about that, paid down their debt, didn't take on more debt. But here we are, we're right back at it. I guess the consumer as a whole, we just can't quite help ourselves as it comes to taking on debt. And so that'll be interesting to watch. Now that interest rates are higher, if we see that number climbing, that could climb pretty quickly with higher interest rates as people are adding debt onto their balance sheets. And so that would be something to watch as far as the health of the consumer goes. Another really interesting chart, I know it's a little hard for you to read, but I think I can explain it to you, is this household excess savings chart. The blue line is the amount of personal savings the consumer has. And what you'll see is there's a huge spike in that in early 2020 when all this government stimulus passed in. And there's another spike in 2021 when more government stimulus came. So all this money pumped into the economy, increased people's saving rates above this dotted gray line, which is the long-term average. But what you'll see now is we're not saving money anymore as consumers. Hopefully you are if you're a master's client. But as consumers, we're spending more than we're making. We're below that trend line and we're spending more than we're making. But because of all this money, the stimulus money that was pumped in, we're still okay. We still have savings from that stimulus money to spend, but we are overspending it. And again, busy chart, I apologize for that. But what you see here in the shaded light blue, that's the total amount of excess savings that was pumped into the economy via stimulus. And you can see we still have a decent amount of that left. We've still got excess stimulus savings. So even though our excess savings has gone negative and we're now spending more than we're making, we still had enough cash in the bank, so to speak, from stimulus to keep us going. But of course, you can see that trend. That number has more than halved in a little over a year. And so what that would indicate is when we fast forward another year, we've probably spent just about all of that money, if not all of it. And if we have this negative savings rate, that's a troubling sign for the consumer. So a few different pieces of information there to tell you there are a lot of good signs in the economy, but there are also some warnings that probably aren't flashing us red, but are yellow lights to say, the consumer might not be in great shape if some of these trends continue. Then the last chart, because we've gotten a lot of questions about it, is some items on the real estate market and what's going on there. Of course, that's just been a wild ride over these last couple of years of what we've seen in housing. But what you see on all these charts is a dotted blue line that gives us the historical average. This chart is housing inventories, how many homes are for sale. And you can see here, we are at an all-time low pretty much, and we have been for about a year. That's one thing driving prices. We don't have enough supply. Rental vacancy rates, very, very low. So a lot of rentals are full. There's not a lot of excess inventory. That also indicates a strong market. How many people are building new homes? Well, a lot of people did back in 18 and 19 and 20 when rates were low, but we see that number dropping. I wouldn't be surprised if that number continues to drop because there's been a lot of people moving, a lot of people building homes, getting good mortgage rates. And now I think we're content to just stay there. Let's just sit there. And then another interesting one here is multifamily housing starts. That's actually increasing. More multifamily houses, so apartment buildings, condos, those sorts of things are being built, which means that we may just not have much more room from a supply standpoint in the individual housing market to go. So it would not be surprising to add all this up to say the housing market might just kind of sit still for quite some time with not a lot of supply, not as many buyers in the market, and not as many houses being built, and a lot of people having moved recently and wanting to stay put. And then, of course, interest rates up significantly. So Lyle, that's what I had on inflation, and we can take some questions on any of that.
Yeah, this question's back to the labor market. Just a curiosity question. What are your thoughts around why the demand for labor is so high? Why are there so few workers for all the jobs out there? That 1.8 jobs for every person looking for work. That's a crazy number. Well, what's going on? What do you think?
Yeah, like many things in our economy, it's a multi-factored equation. So there's a lot of things there, and there's not one that you can point to say that's the one, but a few things that we've seen. One is there's a very high demand for what you would call skilled labor. So a specific type of labor needed. So even our industry or certain trades, really any business that does something specific that you need specific training for, there's a shortage of that. And so why is that? It's hard to tell. One of the questions I would have is, of course, there are less folks going to trade school and training in trade. So that one's obvious. There's just not as many people going there. And the other question would be, how many people who are going to college are getting a degree that allows them to get into skilled labor versus just having a degree that maybe doesn't correlate to something specific? That's more of a speculation on my part than anything, but that could be one factor. But another major factor, we've seen a lot of people retire over the last couple of years, and they didn't call it the baby boom for no reason. That is a huge generation. The baby boomer generation is an enormous amount of people. And so we have a lot of people retiring just naturally because they're in their early, mid, late 60s and it's time to retire. We have some people in that age group retiring a few years earlier than we thought. And there's just less people entering the workforce. There's less numbers of people in Gen Z and even in the millennial generation, especially in Gen X, than there are in that baby boomer generation. And so some of this is just a numbers game, and it could be a long-term trend, because we are not on pace at all to replace all the baby boomers who are going to continue to exit the workforce here over the next decade, because we just don't have the numbers. And one other factor there is younger people are getting into the labor force a lot later than they would have 50 years ago. Of course, more people are going to four-year college than ever. More people are getting advanced degrees than ever. And so that delays the amount of time until they get into the labor market. You know, you go to a four-year school, you go to 2 years master's program. Next thing you know, you're 24 years old and you're just entering the market, where there are a lot of baby boomers who would have done that 1, 2, 3, 4 years sooner. And again, those numbers are converging on each other on each end of the spectrum.
Great, that's helpful. Thanks, Gary. I think that's all the questions for that section.
Great. Well, last thing we have for you today is a few items on this, what they are calling the Secure Act 2.0. This was passed at the very end of 2022. And just like our good old friends in Washington, D.C., some of these things went into effect in 2023. So they pass a bill, and 4 days later, we've got new provisions. So I guess we shouldn't be surprised at that by now. But there's a few points we're going to hit on here. There's a lot in this bill, but probably only a few things that would affect you or affect a group of our clients. The most significant one, I would say, is to change the age for required minimum distributions. Required minimum distributions are money withdrawals that you have to take from any pre-tax, generally IRAs, typically when you turn 72. Now, 72 was a new number just a few years ago. If we go back, I forget exactly what year that was. I think it was 2018 they passed that one. The old required minimum distribution age was 70 and a half. Then they moved it to 72. Now it's being pushed back to 73 for some and 75 for others. So what you see in this chart, if you were born before 1951, your age is still 72, no changes. If you were born between 51 and 59, your RMD age is 73. And if you were born 1960 or later, your RMD age is pushed all the way back to 75. So it just is going to delay the amount of time that you're forced to take money out of your IRAs. Now you would say, why are they making me take money out of my accounts? Well, whenever the government gives you something, you got to pay them somewhere else on the other side. The money in your IRAs you haven't paid tax on yet. And they gave you the ability to not pay tax on that. And so for that trade, they're going to tell you when you have to start taking that money and paying tax on it. So that's the big picture as to what's happening. You can see there the age 73 percentage that you have to take out of your pre-tax accounts is about 3.77%. At 75, about 4%. So if you have $1 million in IRAs when you turn 75, you're going to have to take a little over $40,000 out of your accounts in that first year. But one thing that did not change, which presents fantastic tax opportunity, is there are no changes to the age 70 and a half for qualified charitable distributions. Qualified charitable distributions are money that you give directly from your IRA to a charity. And if you send it right to the charity, you never pay tax on that money. And so that stayed at 70 and a half. And what this does, it gives us a longer window to get money out through QCDs tax-free out of your IRAs. There's a few other planning opportunities here with RMD changes. Another thing is your IRAs grow tax deferred. You don't pay tax on those until you withdraw money. So you have a few more years of money growing without a tax drag, which does add to the accumulation in your accounts. One thing that we look at a lot for our clients are Roth conversion opportunities. Roth IRAs are not subject to required minimum distributions. There's no required withdrawal required from Roth IRAs. So what we'll do is if we have a client with a lot of pre-tax assets that are going to be subject to required minimum distributions, we might choose to take money out of that IRA earlier than we need to and pay tax on it, but then move it right over to a Roth IRA. And now we have it in a tax-free bucket, not encumbered by required minimum distributions. And when we look at that over a period of 10, 20, maybe even 30 years of growth, tax-free growth, it can add significant ending wealth to your overall portfolio just because of the tax and then the tax-free growth on the back end. What this does, it gives us more time to do Roth conversions because we have more time that we're not forced to add taxable income through required minimum distributions out of your IRAs. So that's a big opportunity that we'll be looking at. If that's applicable to you, we'll be talking about it with you and deciding if Roth conversion strategies make sense in your plan. And then I mentioned QCDs, qualified charitable distributions. That's money that goes tax-free to a charity. We've got a few more years that we can do that without having required minimum distribution. And because we're spending money out of your IRA, it takes down your IRA account balance, which lowers that percentage calculation of total dollars that I have to take out in a required minimum distribution. And so what we want to do with these sorts of opportunities is we want to keep as much control as we can of your tax situation and make it as advantageous as possible for you, and a little bit more room and a little bit more time that we're not forced to do something gives us more flexibility to find some of these planning opportunities. The next big thing we wanted to touch on about the Secure Act 2.0 are some changes to retirement savings. One of the big ones is if you work for a small employer, you're self-employed, and you have a simple or a SEP IRA. If you don't know what those are, you never heard of them, you can probably ignore what I'm about to say, but you can now have a Roth option inside of a SEP or a simple. So you can contribute Roth money, after-tax money that grows tax-free in those plans. That was previously only available in a 401k or 403b plan. So added benefit to be able to do Roth contributions. Another big change with Roth is you can now send your employer contributions to a Roth account. You weren't allowed to do that previously, but if your employer provides a match or a profit sharing contribution, you can designate that as Roth. You pay tax on it in the year you get it, but then it's tax-free long-term. The other big change that starts in 2024 is the catch-up contribution, which when you turn 50, you're allowed to put more money, additional money into your 401k, will now be required to be Roth if you make over $145,000. I think that number is a little higher. They index it for inflation. I think they did that already. But if you make what they're deeming as too much money, they're going to force you to pay tax on that money today. So the reason that they did that is Congress likes Roth IRAs because they get paid now. And that helps whenever you're doing a bill like this and you're spending money in a bill, you have to offset it with more tax revenue. In my opinion, that's one of the reasons that they did that and that they're going to force these catch-up contributions to Roth. A few other changes on retirement savings. Starting next year, 2024, they will index the IRA catch-up contribution to inflation. Right now, the catch-up for an IRA is $1,000. That'll increase every year. So hopefully they at least round to maybe a 10th or a 100th. So Lyle and me and John and Charlie aren't giving you some crazy odd number as far as what your limit is for this year. But I think they will do that. But that'll help that catch-up contribution continue to grow. Another interesting provision, this starts in 2025, is in 2025, if you're between the ages of 60 and 63, you're going to have an enhanced catch-up contribution. So you'll be able to put even more. The current catch-up is $7,500 on that you can put in a 401k on top of the regular limit of $22,500. So if you're 50 or older in 2023, you can put $30,000 in your 401k. This will increase that even further. There's some formulas and whatnot that are involved here, but projected, we're looking at, instead of 7,500 in catch-up, we're looking at maybe 11,250 plus or minus. So more ability to put money away, especially in those last couple of years of retirement. But if you're able to do that, you're probably making more than $145,000 a year, and that's going to have to be all Roth, which is not all bad. You know, we're never going to complain about having tax-free money, and this gives us another avenue to get tax advantage money away for retirement. And then the last piece on retirement savings changes, that simple IRA catch-up contributions are also increased. They're still lower than than your limit in a 401k, but similar parameters to the 401k increases that you can put a little bit more money in your simple IRA plan. If you're not sure what you have, or you're not sure exactly where you stand on where's my simple contribution at, or where my 401k contribution at relative to these limits, of course, just shoot us an email and we'll help you out with that. And the last big piece here, and my last slide for us today, before we finish up with some questions, are some new provisions around 529 college savings accounts. Many of you have 529s for your children, maybe even for your grandchildren, to help pay for college expenses. And one of the questions we get is, hey, what happens if I put all this money in a 529 and my child doesn't go to school, or they get a scholarship and they don't need the money? Now the money's stuck in a 529, can I get it out? Well, you still have the rule that if you don't use this for education, you have to pay tax on your investment earnings in the 529 plus a 10% penalty tax for not using it for education. So it's relatively penal as far as that goes. But you are now given another option. If you have leftover 529 money that you don't need, you can transfer those assets directly to a Roth IRA for the beneficiary of the 529. So if your child's the beneficiary of the 529, you can put money into a Roth IRA for that child. Now, there are a number of provisions with this. Of course, the Roth IRA and the 529 have to have the same beneficiary. Beneficiary does have to have income, has to have compensation to be able to do this. They have to be working to some degree. You have to have had the 529 in place for 15 years or longer. So start them early. Start them now if you don't have one, just in case, even if you just put $50, $100 in just to get that ball rolling, in case somewhere down the line you want to take advantage of this option. You can't move any of them into any contributions that you've made in the last 5 years into a Roth, and you can only put $6,500 in per year up to a lifetime max of $35,000. Lots of rules here. But the headline on this is it is another positive in the column of the 529. The government wants to encourage savings for college. They want to encourage people to take more of that upon themselves to pay for college. And so they're going to continue to make that easier through expanded options here on the 529. We think this is could provide some wonderful opportunities. It's definitely a great release valve if things don't go as you expect, that, oh, we've got another out here. But it's also a long-term planning strategy, especially from a legacy asset standpoint, where you load up a 529 and it can be dual purpose for your children or your grandchildren, where maybe you end up using it for school, or maybe you use it as a gift to get a Roth IRA started, teach that beneficiary about saving early, get money in a tax-free account for them to help their future retirement savings. Lot of great opportunities here. So that wraps up our main points on the Secure Act. Bear with me here. I need to read all these disclosures word for word to you. Just kidding, of course. That wraps up what we had for today. And Lyle, let's finish with a couple of questions, maybe one or two here. So we've got 3 minutes to go.
Yeah, one of the questions we have is related to Congress making changes in this area. They just made one here in 2018 that took effect in 2019. Now we're 3 years later, and we have another one. What are your thoughts about continual changes in the ages and other provisions related to retirement? Speculation, of course.
As far as what may happen in the future?
Yeah, and even some of why are they doing this in the first place?
Yeah, why are they doing it? I think that's almost a nuclear question. Why is government doing something for me to try to answer? But I think the long and short of this is, there's all sorts of different lobbies down in DC, and one of them is for the consumer. Another one is for the insurance industry and the financial services industry. There's different union lobbies and all these sorts of things. So there's a lot of people working in DC on the side of the worker. And so I think a lot of that gets into Congress of, hey, let's continue to help the worker, help the consumer, which some of these things do. I think there is also a recognition that the government tends to be late on to the game on a lot of things. And certainly life expectancies, changing workforce, that they tend to get behind on that. So they do these things to catch up. But another thing that maybe gets a little more to my cynical side on some of these, Lyle, would be what I said about the Roth. This Secure Act includes all sorts of things. We just told you the couple that we think are relevant to you. There's all sorts of things related to retirement and not. So if I'm in Congress and I want to fund something, I want to do something, I want to spend the government's money, the taxpayers' money somewhere, I need money via tax revenue to fund that. And so when you look at them forcing more money to Roth, that brings immediate tax revenue and helps solve that equation. So if we're getting cynical, I might say, well, they want us to go to Roth, so they have tax money now so they can pay for whatever's on their list in the future. And if any of you read about that bill, there's some questionable items that were included in that bill as far as things that the taxpayers' money is going towards.
Good. I've often thought too, it seems like eventually they're going to have to work on the Social Security age. I don't know if that's anything underlying this at all. It's kind of just, again, my 2 cents on it, but it does seem like possibly they're setting us up that, hey, we're going to have to move the full retirement age from 67 back a few more years. And if we had required distributions at 70.5 or even 72, it might get a little tight. So who knows? This stuff takes a long time to play out, but I think that could possibly in the cards at some point as well.
That's a great point, and that very well could be true.
As far as questions, well, actually, hang on, let me a second. I just got one here. There's a question about 529s. Can grandparents create or fund a 529? Yes.
There's a great planning strategy in there for grandparents. If you have grandchildren, get that 529 open. There's a number of benefits to a grandparent having a 529 in the name of a grandchild versus a parent. One of them is if a grandparent has a 529 for the child, those assets aren't included anywhere in the FAFSA form in applying for aid or grants or scholarships, where if they're in the parent's name, they are factored into the equation. So it hurts you a little bit on that. That's always been true, but certainly this, I think it's a great long-term potential gifting strategy for grandparents and their grandchildren. So yes, absolutely, you can do that. I think there's a lot of merit to looking into that as a grandparent as a long-term gifting strategy.
Well, we're out of time. We filled up an hour, so thanks for everybody for joining us. Sorry, I got a little delayed in getting into the video here. So, but thanks again, and thanks, Gary, for all your insight. It was great.
Thanks, Lyle. Thanks everyone for being here. Of course, any other questions you have, send them our way. We appreciate your continued partnership with us from the whole team at Masters, and enjoy your weekend.
Bye now.